Hi there, I'm Edward Kalstian, founder of IDEXX Capital, where we look for market-beating stocks for the long run. Today, we're breaking down IDEXX Laboratories, the global leader in veterinary diagnostics, providing essential instruments, reagents, and services. With veterinary care becoming increasingly high-tech, IDEXX plays a critical role in a growing, non-discretionary industry. But does the stock's premium valuation make sense based on the fundamentals? We'll break down IDEXX using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Great companies start with capital efficiency. Looking first at return on invested capital, IDEXX stands at 39.2%, Zoetis at 24.9%, and Vetoquinol at 12%. On this metric, IDEXX is the clear leader. Its combination of recurring consumables, high-margin diagnostic instruments, and disciplined capital allocation has consistently produced exceptional returns. Zoetis also performs strongly, but IDEXX maintains the edge. Next up, return on equity. IDEXX stands at an exceptional 57.7%, Zoetis at 51.1%, and Vetoquinol at 10.6%. IDEXX's current return on equity is massive, outperforming both Zoetis and Vetoquinol. However, the return on equity has been declining over the last 5 years from prior peaks, though it remains top tier. Zoetis has remained stable around 50%. This high return is partly due to strong profits and the impact of share buybacks. IDEXX is a profitability leader, but the declining 5-year trend is a key watch point for investors. Returns today are nice, but without growth tomorrow, the compounding machine stalls. Over the past decade, IDEXX has shown impressive strength. Revenues have grown at a compounded annual growth rate of 10.4%, and net income has grown at a CAGR of 18.5%. Now diving into earnings per share growth, earnings per share for IDEXX have grown at a CAGR of 20.1%, Zoetis stands at 26%, and Vetoquinol at 9.8%. IDEXX has delivered a compelling double-digit growth profile, driven by recurring revenue from diagnostic placements. While Zoetis leads, IDEXX's underlying growth is robust. Even the strongest business models can crumble under weak balance sheets. Here's where IDEXX stands. IDEXX holds $0.3 billion in cash against $1 billion in total debt. Total free cash flow is $0.8 billion, and this yields a very healthy free cash flow to total debt ratio of 80%, where 15% is the bare minimum. This 80% ratio means the company could pay off its entire debt load using just over 1 year of free cash flow. Furthermore, the debt-to-equity ratio has improved dramatically, falling from approximately 5.9 in 2019 to 0.6 in 2024. The financials are rock solid. IDEXX has low leverage and outstanding free cash flow generation, making it highly resilient. Even a great company can be a poor investment if expectations are already priced in. IDEXX trades at a price-to-earnings ratio of 57.9, Zoetis stands at 20.7 and Vetoquinol at 14. So IDEXX trades at a significant premium. But to account for growth, we use the PEG ratio, comparing price to earnings to the long-term earnings per share growth estimate of 14.8%. This gives us a PEG ratio for IDEXX of 3.9. Zoetis stands at 2.65 and Vetoquinol at 1.75. IDEXX is the most expensive stock. A PEG ratio of 3.9 is very high and suggests the stock is currently overvalued based on consensus future growth, making valuation the primary risk factor. The moat is what protects profits in the long run. IDEXX is the undisputed leader in veterinary diagnostics. The IDEXX moat is built on switching costs and workflow integration. Vet clinics invest heavily in IDEXX's proprietary analyzers, which then generate recurring, high-margin revenue from consumables. Switching is costly and disruptive. IDEXX's software seamlessly integrates diagnostic results into the clinic's management system, creating a deep digital lock-in. IDEXX's infrastructure moat is arguably more durable than the patent-based moat of pharma companies like Zoetis. The recurring, essential nature of diagnostic testing makes IDEXX's revenue stream sticky and predictable. Investors choose IDEXX because its moat of high switching costs and deep integration is a superior competitive advantage. Now, before we wrap up, the financial visuals in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Here's what our 5 key factors reveal about IDEXX stock. IDEXX has an exceptional 57.7% return on equity, but the 5-year trend is declining. Over the last decade, earnings per share has grown at a strong 20.1% CAGR, maintaining double-digit expansion. Financials are rock solid, with a free cash flow to total debt ratio of 80% and a low debt to equity of 0.6. IDEXX trades at a steep PE ratio of 57.9 and a high PEG ratio of 3.9. IDEXX's moat is highly durable based on non-discretionary diagnostic instruments, high switching costs, and essential veterinary workflow integration. What do you think? Is IDEXX's dominance worth the steep price, or does the valuation leave too little margin for safety? Drop your thoughts in the comments, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.